Meet Diane and Marcus. They retired within 3 months of each other at 64 with roughly $900,000 each. Both had what their financial advisors called a conservative balanced portfolio. Safe stuff. Bonds on one side, stocks on the other. The year they retired, the bond side of both portfolios did something bonds are not supposed to do. It fell 13% in a single year. Marcus panicked and sold everything into cash. Diane had already built something that meant she never had to sell a single thing she owned in a down market. And the only difference between them was that Diane understood how the quietest part of her portfolio actually worked, and Marcus had been nodding politely at his advisor for 20 years. And before we go any further, there's one thing I want to name about Diane. She wasn't smarter than Marcus. She wasn't wealthier. She had just spent about 15 minutes at some point in her life learning one rule, and then she built her whole plan around it. And this video is that 15 minutes.
So here is the rule. Every single thing that follows depends on it. When interest rates rise, the price of existing bonds falls. When rates fall, the price of existing bonds rise. They always move in opposite directions without a single exception in the entire history of the instrument. And here's why that rule exists. Imagine you buy a bond for $1,000, paying 3%, so $30 a year. And then a few months later, new bonds are issued at 5%. Those new bonds pay $50 a year for the same $1,000. Now, if you try to sell your bond, nobody will pay you $1,000 for it, because the market just made something better available. The only way you can sell it is to drop the price until your $30 payment works out to a competitive yield at the new rate, which means your $1,000 investment is now worth roughly $600 on paper. You haven't lost any future payments. The bond still pays $30 a year and still returns $1,000 at maturity. But on paper, your investment dropped 40%. Not because anything went wrong with the borrower, just because rates moved. And that one rule is the entire explanation for what happened to Marcus.
In 2022, the Federal Reserve raised rates faster than at almost any point in the last 40 years. Rates went from near zero to over 4% in about 9 months. Run the rule. Rates rose dramatically, which means the price of every existing bond fell dramatically. The broad U.S. bond market fell 13% that year. The worst calendar year in the index's history going back to 1976. And if you held long-dated treasury bonds, the kind often described as the safest assets on Earth, some of them fell 39%. And here's the line that changes how you hear this. That was not the worst year for long bonds since 2008. It was the worst year for long bonds going back to 1754. Not a typo. 1754. When there were 13 colonies and the United States did not exist yet. Marcus saw his safe sleeve bleed and he sold, which converted a temporary paper drop into a permanent real loss. Diane saw the same numbers and spent from the cash she had specifically set aside so she would never have to make that decision.
And here's what Diane understood that Marcus didn't. A bond price drop is only a real loss if you are forced to sell. If you hold a bond to its maturity date, you still collect every scheduled payment, and you still get your full principal back on the day it was promised, no matter what happened to the price in between. The price drop is only dangerous if your plan requires you to sell before the maturity date. And that is the entire logic behind what Diane built. A structure called a bond ladder, which is the most practical thing in this entire video, and the thing that separated a comfortable retirement from a part-time job. Here is what a bond ladder actually looks like. Instead of buying one bond that matures on one date, Diane bought several bonds that matured in different years. One maturing in year 1, 2 in year 2, 3 in year 3, and so on. Every year, a rung of the ladder matures and delivers cash. She can either spend or reinvest at whatever the current rate happens to be. This means two things simultaneously. She always has money coming in without selling anything early, and she is never permanently locked into yesterday's rates, because she's constantly reinvesting into current conditions. If rates rise while she holds the ladder, each new rung she builds captures the higher rate. If rates fall, she already has several years of higher-paying rungs locked safely in place. The latter removes the need to predict anything. It just works in either direction. And if the bond ladder feels like the thing that would have protected Marcus from a decision he made under pressure, the like button is right there. It means the structure is working and the next video gets made. Now, here's the number that explains why this matters, even if you're 35 and retirement feels distant. Right now, a 3-month U.S. Treasury bill pays approximately 4.4%. The FDIC national average savings account rate at major banks is 0.38%. Same money, same safety. FDIC insured in both cases. If you have $50,000 in a big bank savings account earning the national average, that balance earns $190 a year. In 3-month Treasury bills, that same $50,000 earns roughly $2,200 a year. The only difference is which institution holds the cash.
And this is the mechanism that operates on Marcus's behavior, without Marcus ever noticing it. It doesn't feel like a loss. The money is still there, the account balance hasn't dropped, nothing alarming happened. But the purchasing power quietly drains, and the opportunity quietly disappears. And 5 years later, the number that should have been there isn't. This is the category of financial damage that never arrives as a bill and never announces itself, and costs more over a lifetime than almost any stock market crash ever will. But there is a second invisible enemy, and it is more patient than rates. Inflation at 4% cuts the purchasing power of your savings in half in roughly 17 years. A plain bond at a fixed rate is fully exposed to this because its payments are frozen and inflation doesn't care. Which is why the Treasury created something called TIPS, Treasury Inflation Protected Securities, where the principal automatically rises with inflation, so your interest payment rises with it. You are guaranteed a return above inflation, whatever inflation turns out to be. A fixed bond cannot promise that. And the I-bond, which is the friendlier consumer version of the same idea, currently pays a combined rate of about 4.26%, with a fixed base rate of 0.9% locked in for up to 30 years, meaning some percentage of your return is guaranteed above inflation for 3 decades. Purchase limit is $10,000 per person per year through treasurydirect.gov, and you must hold it at least a year. But the mechanism is the single most direct inflation hedge available to someone who doesn't want to manage a complex portfolio.
Now, let's come back to Diane and Marcus, because the point was never just the bond ladder or the inflation hedge or the savings account gap. Those are tactics. The point is the underlying thing those tactics protect. The reason Diane slept through 2022 and Marcus didn't was not that Diane made better guesses about where rates were going. Nobody predicted 2022 accurately, including professional bond managers. It was that Diane had built a structure that meant she was never forced to make an urgent financial decision under emotional pressure and with her retirement money on the table. Every dangerous financial decision in history, panic selling in a crash, leaving cash in a zero-rate account, staying in a high-fee fund because changing it feels complicated, all of them have the same shape. A person without a clear structure making a decision under pressure, using the first option that reduces the immediate discomfort. The bond ladder and the tip and the I-bond and the cash bucket don't make Diane smarter. They remove the conditions that make panic available as a response. And that is the thing nobody says about bonds. They are not an investment that competes with stocks for returns. They are the infrastructure that makes it possible to own stocks through every crash without selling at the bottom. They are what keeps your growth engine running when the whole world is telling you to shut it off.
The people who understand this are not smarter than the people who don't. They just spent about 15 minutes learning one rule, and then they built their plan around it. Marcus is back at a part-time job, not because he made one bad decision in 2022, but because he never had a structure that made good decisions automatic. Diane is traveling, not because she's lucky, because a wall she built 10 years ago is still standing. I make these videos because I find it genuinely unreasonable that the quietest and most powerful corner of personal finance is the one that nobody ever explains in plain language. So subscribe, and I'll keep being unreasonable about it on your behalf.
The video on your screen right now might be more helpful for you, so click and watch.